I'm Keith McCullough, and welcome to another real conversation. I quite like these when I get somebody who does global macro the way that Jurrien Timmer does. We've known each other for quite some time. I haven't seen you in a while because I haven't been to Beantown in a while, but welcome and thanks for making the time as always.
Yeah, it's great to see you, Keith.
Have you been cooking things up lately? I don't know if people know how good of a cook you are.
I'm always cooking things up.
Is Burning Man still on? Are you still doing that? If you don't mind me asking.
I run a food camp at Burning Man, and the last 2 years were rough. One was extremely hot and windy, and then last year, of course, was the mudpocalypse. So we're hoping for something in between maybe this year, but I run a team of 85 people, all who work in the kitchen to cook up about 5,000 meals during the burn, mostly intended for the artists who are there doing some fairly thankless work, but also for the community at large. So
that's awesome. That's it. What's tougher, that or doing global macro?
Global macro.
Well, I want to, eventually we'll get to other parts of the world, but I think the U.S. fully loaded with everything you've been writing. Election concentration risk in the market. Maybe we start with that actually, because you've some great data, just kind of like putting this moment in U.S. capital markets or equity markets in the context of time and how you've written about, like I said, the concentration factor.
Yeah, so it's certainly been an unusual cycle. You know this as well as anyone. Obviously, the pandemic, wreaked havoc on the world. And also on the analysis of market cycles, right? I mean, studying market cycles is already a challenge because there aren't that many of them, right? If you go back 150 years, there's only a couple of dozen of them. And so, you look at averages of a highly dispersed and not very large sample size, and it leads to issues. And then you have the pandemic on top of that. And on top of that, we've had sort of what I've always called the Nifty 50 aspect. Of course, these days it's more like a Nifty 7 or a Nifty 5. But this notion of mega cap growers leaving the market, it doesn't happen often. It's only happened twice before this time. And one was the original Nifty 50 during the early 70s. Mm-hmm. Where after the 68 speculative bubble of glamour stocks, had burst, the market was really in the hands of institutions, and they only wanted to buy the blue chips, IBM, Xerox, Colgate, companies like that, that were proven to be solid, sustainable earnings growers, and they bid these companies up to really high valuations. The top 50 at their peak in 74. Were trading at twice the valuation multiple as the bottom 450. And so that's a pretty significant extreme. Mm-hmm. And then, of course, the great inflation happened. And, if there's one thing that will kill valuations, it's inflation. And by the end of the 70s, all valuations had, converged back to, around the high single digits. And then we had another episode of that, of course, the tech bubble in the late 90s, totally different animal. That was simply a case of these, big growers, Cisco, Dell, those kind of companies during the internet boom, just, running away from the herd, from the pack. And again, those stocks ended up trading at twice the multiple. They were trading at 40x, whereas the rest of the market was at 20x. And of course, that bubble burst. It burst for a different reason. It imploded on itself just because those stocks were over-owned and the valuations were stretched, and et cetera, et cetera. And that converged in really the largest rotation I think we've ever seen of small caps value, anything not large cap growth, kind of catching up, at least on a relative basis. And then about 10 years ago, the latest era started. It's going on for 10 years now. The top 10 stocks have outperformed the bottom 490 by like 112 percentage points, just astronomical. But they're not yet trading at the valuation extreme. The top 50 are only 30% more expensive than the bottom 450. So we have this weird scenario where the big growers are really running away, and we know who the names are, of course, and that's kind of worrisome because you want markets to do well, but you don't want them to do too well because it tends to be not sustainable, and so this is kind of one of the big puzzles that we as asset allocators struggle with because, we're always looking for opportunities. You've got the beta, of course. Are you overweight equities or are you underweight bonds, et cetera, et cetera? But there's also the alpha, like,
Yeah.
are you betting on mean reversion between large growth and small value and value in general? And by extension, that becomes a trade on commodities versus stocks. It's a trade on non-US equities versus US equities. It's all part of the same trade, and it's driven by the dominance of these mega cap growers. It's not that the rest of the market is bad, it's just that they can't keep up with the runaway performance of these large growers.
Yeah, that is an unbelievably succinct rendition of what's happened empirically and from a historical perspective, obviously. You're very familiar with my process, like the quads, and how we try to contextualize the why, so to speak, on that. What does have something that's very common to the 1970s, in particular the point in time that you cited, is stagflation. We would call that quad 3. We do have, like, at least from our perspective, I think the market's actually raging quad 3 right now. Like, if we show slide 8, guys, where and you've seen this before. You and I have sat down quite a bit in your office, and we have good conversations about this. But when you think about, like, if it is quad 3, like, according to me, the best equity sector style factors are indeed secular growth, momentum, quality, and the laggards are smaller cap, value, et cetera, et cetera. So from my perspective, as a younger man, I think I'd whine about it a lot more. As an older man, I just accept it. I mean, it's just what it is. It's obviously nothing like the 1970s in terms of, the 50, now you have the 7. It's just always different parts. But conditionally, what do you think about that? I mean, obviously the main thing with stagflation is that the mainline economy is starting to slow again, and secular growers, ostensibly the market's saying they're going to grow through that, therefore they're going to have a higher multiple.
Yeah. And by the way, there's great liberation in accepting the things we cannot control. So I'm with you on that. But that tends to come with age. So maybe you and I are in the same boat there. But yes, so you're right. And it's interesting how the narrative of the mega growers has evolved, right? So obviously during the pandemic, they were the stay-at-home stocks, so it's easy to see why they would outperform. Then we had a big rotation in late, 2020, and then of course the Great Reset happened when the Fed raised the cost of capital in 2022. And at first, they got clobbered because they're long duration stocks. And obviously, if the discount rate, per discounted cash flow model goes up, then the long duration high PE stocks should get hit. But then the narrative changed. And then all of a sudden it was, well, actually, maybe they're a reprieve from higher interest rates because they have strong balance sheets and they don't need to borrow and they don't really care where the Fed's going with rates because they have so much cash. And then the narrative changed to now it's AI all the time, and that's certainly a valid narrative. But it's just interesting how they keep coming back. And as I said, from a valuation perspective, they're not really that rich, and it's hard for the rest of the market to compete because if you think about it, and I will answer your question in a moment, but when you think about it, the S&P equal weighted index, right, SPW, is up 5% year to date. The SPX, the cap weighted index, is up 17% year to date. So imagine if you're like a regular normal stock, not like a mega grower. If the S&P 500 was the SPW, all you needed to do was go up more than 5% and you would be outperforming. But today you would need to go up more than 17% just to outperform the S&P cap weighted index. And that's why there's such a dispersion between the absolute breadth of the market. 66% of the stocks in the S&P are above their 200-day moving average, but only 29% are outperforming the index. And that's a really interesting phenomenon. And obviously, if you're a passive investor, you don't really care. But if you're an active investor, you care because that's a pretty small pond to fish from if you're looking for relative winners. But to your point, I think you raised a question about inflation, and to me, inflation if you can figure that one out, you can figure out almost everything, right? You can
Yep.
figure out the risk premium in bonds, you can figure out the risk premium in equities, and one tends to drive secular bull markets, one tends to drive secular bear markets. So inflation kind of tells you everything else, and the inflation rate, as we all know, has been coming down, but that last mile of going from 3 to 2, has been obviously challenging. I mean, the core PCE is at 2.7, but the CPI and longer measures of PCE are in the threes. And if 3 is the new 2, I mean, that's not the end of the world. I mean, if 10 was the new 2, that would be the end of the world, but 3 is not. But it's a different ball game, and it informs us how much the Fed can respond if and when a real recession happens. So far it hasn't happened. Some people argue that we had a mini recession in 2022 and then a soft landing, and certainly the labor shortage is being corrected. We saw that in the non-farm payroll report and the JOLTS report. So it's not quite Goldilocks, but it's not a recession, and the inflation rate is not running at the same rate as before. And so in the meantime, you have this mega cap dominance, which is the stocks that are in your quad 3. And again, without a valuation extreme, there's really no reason why they can't keep going, other than it becoming just overcrowded because of how persistent that gain has been. But again, even then, right, if you look at bubbles, historically, a bubble by definition is a valuation extreme. I mean, otherwise it wouldn't be a bubble. And so far, a lot of the price momentum of these stocks are supported by earnings. And and if there's one mantra we have in this building here at Fidelity, it's that price follows earnings, and relative price follows relative earnings, and earnings revisions will tell you a lot about where the price momentum comes from. So I think you're in the right quad there.
I think I always it's always kind of a bee in my bonnet. I don't really get too upset about that either. But I mean, I never start with valuation. I start with the rates of change or the prevailing conditions of the economy, right? The quads. And never in the history of the stock market has valuation been a catalyst to sell. I mean, the rate of change of slowing at the end of 1999 into 2000 was a catalyst to sell. The rate of change of slowing at the end of 2021. All the mega caps collapsed in 2022. But you need that catalyst. On the inflation piece, I wonder where you're at on this. Guys, show our nowcast, because we've been way outside of Wall Street for the whole year, really the last 6 months, saying higher for longer on this, Jurrien. So I wonder, and you could still see, so we have inflation just kind of staying where it is, maybe a little hotter in July and a little lighter in August that'll be reported ahead of the first cut in September. But after that, they're very easy base effects for inflation. And I consider it, and I think the bond market does too, and so does the currency market. Strong dollar, interest rates have been higher for longer. To me, that, first of all, that's quad 3 because it's inflation going up, not down. But two, I am surprised that Wall Street has almost, I call it the preferred outcome for inflation, which is to go towards the Fed's target as the consensus. What do you think about that?
Yeah, no, it's a great point. And let me just address the first part about valuation not being a catalyst. I completely agree.
You do. Thank you. The buy side agrees. Imagine that. The sell side probably doesn't.
So valuation is an amplifier.
Yes.
Once a catalyst has been triggered, and that catalyst has to be some measure of growth, and in the way I look at it, it would be earnings growth. And I have this conversation with my asset allocation colleagues here all the time, because it's so tempting to say, let's buy IFA and EM because it trades at a 14 multiple, the US trades at a 21 multiple. It's low-hanging fruit. And so that urge to diversify outside of the US is very strong, because that valuation difference, it's like a temptress, it's so appealing. But I have a chart that shows the relative performance of MSCI US versus ex-US, and the relative earnings of MSCI US versus ex-US, and they are virtually the same line. And so we can have that valuation um, um, carrot out there as much as we want, but without a difference in like the rate of change or the second derivative of earnings or estimates, it's just not going to happen. But
That,
so
by the
I
way,
think
if you don't mind me
like
interrupting
you
before,
have a loaded, you have a load, if you've pulled it, sorry, go ahead, you go
no,
first.
I was just going to make the point on because you said a whole bunch there, and I don't want to lose that one. The point on EM. If you only bought the most expensive EM market for the last year, which is India, you would have nailed it, right? Yep. You didn't buy the cheapest, you buy the most expensive. Why? Because it has the best growth rate. So yes. Again, that's why I actually was originally a stock picker, and I believe just like Fidelity does, the rate of change of sales and earnings growth, if you get that right over time, you're on a trending basis, you can get that right. Slide 134, though, we showed this is a huge delta. This shows the extremely strong delta between India, in its growth rate versus the median G20. This has been monstrous, Jurrien. And the amount of times that I've had buy-side clients tell me, when they start with valuation, that's code for I missed it. Have you ever heard somebody tell you that they're going to move out of their house because it's too expensive, it's valued too highly? I mean, not in Newton, Mass. I don't think. I think they'd like to have that. So I just wanted to say that because EM too is a glaring example of what you just said.
Yeah. And anyway, so I think of it as, you have a gun, not to use a gun metaphor, but you can pull the trigger, but it also needs to be loaded for anything to happen. And so you need the valuation difference to help you once the catalyst is triggered, but you need the catalyst. And so the U.S. versus non-U.S., even growth versus value, is an opportunity, but it awaits a catalyst, and that's what we have to solve for. I mean, valuation does affect price over the very long term. I mean, the CAPE model, I've done a lot of work on it. I look at the price to free cash flow, and over a 10-year horizon, there is a very close inverse correlation between the trailing PE and the forward return, which makes a lot of sense over the long term, because if you're investing a long-term portfolio at a 30 multiple, you have a higher hurdle rate than if you're investing over a long time at a 10 multiple. So that makes sense. But over like 1, 2, 5 years, there's really no causal effect. So anyway, but let's go to the inflation, because that's a really good observation. So we're in agreement. So our in-house view, not that we have a house view, but our internal economic team thinks it's going to be higher for longer. And remember, inflation has been trending above average now for the last 4 years or so. And so you don't just need the year-over-year inflation rate to go to 2. You need like the 2-year CAGR or the 5-year CAGR to go to 2, which actually would either mean that you have to wait a long time for 2% inflation to turn into long-term 2% inflation, or you need to undershoot the 2% and have actually, some deflationary periods to get back to 2. So just because the core PCE is at 2.7 doesn't mean the Fed or anyone else can declare victory. And I think the Fed actually is doing a really good job by being prudent and by not easing too quickly. I mean, now after the payroll number and the core PCE numbers from a week or two ago, I think the odds are now greater. I mean, on Bloomberg, the WIRP shows about a 75% odds of a September cut, and I think that's right. I've different measures of the Taylor rule, and they're all coming down because the unemployment gap is coming down and the inflation gap is coming down. So it makes sense that the Fed, in order to maintain a certain real rate, policy rate, that it would bring the nominal rate down as the inflation rate comes down. But I think there's a limit to how far it can go. I think the days of ZIRP and QE, well, maybe not QE, but the days of ZIRP are probably behind us. And so that limits, how much yields can fall. And I think the Fed, again, is being correctly prudent in waiting longer than it should, rather than moving too quickly and then having to take it back. And I think also the Fed knows what its policy mistakes were in the past, back in the 60s and 70s. It sees the fiscal dominance, entering the scene, and at least for as long as it can, it will lean into that, which I think are all the correct things. But I agree that inflation, 3 is the new 2, maybe 4 is the new 2. Again, it's not the end of the world when you look at the relationship between the PE ratio and the inflation rate. There's a very clear inverse correlation that when you have positive inflation, the lower that positive inflation is, the higher the PE, and the higher the inflation, the lower the PE. And then when you go into deflation, it goes in the other direction. But we're still, even at 3-4%, we're still kind of in the sweet spot for equities, where it can have a decent PE. When you get above that, the PE gets clobbered as it did in the 70s. But I don't think we'll get into that zone. But I do think inflation will be elevated. We have all the things we know about deglobalization, onshoring, the labor arbitrage of this global, phenomenon over the last couple of decades, where EM got unleashed and joined the global workforce. I mean, that's been largely played out. So that labor arbitrage isn't quite there anymore. So I think we've passed the sweet spot of inflation, of disinflation, I should say. And that tells me that, interest rates, long-term bond yields, maybe there's a term premium trade there, because there is no term premium right now. And if you combine higher inflation and fiscal dominance, it's easy to see that long-term bond investors might want to get compensated for inflation risk going forward. But equity I think should be okay. And then it's just a question of where in the equity markets you're investing.
Yeah, I'll come back to fiscal dominance when we talk about U.S. debt. I know you have thoughts on that. Fiscal dominance is a really important topic that not everyone talks about, but you, of course, talk about everything and right on cue. But first, you opened the door for me to pick at the Fed here a little bit. Slide 46. I wonder what you think. Like the Federal Reserve, it's like watching, according to me again, I think it's like a shell game. And well, what we really watch is this, right? So when inflation was, when they didn't want to talk about shelter, let's look at core services, less shelter. So when it was going down, that's what they want to talk about. Well, now they don't talk about it because it's going up. And it's not going up to 3. It's gone to 5, right? And it's stayed up there. What do you think about that? I mean, just the point and principle of like, what is Fed policy? I mean, is there actually like a Taylor rule or a rule that they're going to use core services, less shelter, or not? I mean, because if they were, they might even be raising interest rates.
No, it's a good point. I do think they look at versions of the Taylor rule. I probably have like 6 different iterations of it, because you have to make so many assumptions, right? You have to make an assumption about whether the TIPS market is correct. And actually, I meant to bring that up earlier, which is a whole other conversation about are the markets just being hopeful, or are they just betting on mean reversion? Because the TIPS market, the forward curve in the TIPS market has been predicting, 2.5, 2.3% inflation for the next, 30 years. And you wonder, like, what goes into those algorithms? Like, are these a bunch of PhDs trying to figure this out, or is this just some mechanical thing in the market? And so that's a whole other conversation. But I think the Fed, by and large, is trying to do the right thing, but they're facing a dilemma that they have not had to face for some time, right? Because the Fed has a dual mandate, of course, at least 2 mandates, full employment, price stability. And for the last couple of decades, it hasn't really had to worry about price stability. Whenever there was a shock to the system and the unemployment rate would go up, they go to 0%, they unleash their balance sheet, and the inflation rate never went even to their target, let alone above it. And now they're in a situation where the unemployment is fine, but the inflation is not. And I think the Fed, therefore, correctly raised the cost of capital from 0 to 5 3/8, a couple of years ago, and it's shrinking its balance sheet. Although that shrinking balance sheet has had very little effect because of the mechanics of the plumbing of reverse repos and all that stuff. But the balance sheet has shrunk by 1.5 trillion over the last couple of years. But what I worry about or think about is like if we get a recession at some point and inflation remains above target, that'll be the first time in a long time, if not ever, where the Fed would have to equally weigh those two mandates, right? I mean, like how much can they ease policy to correct the rising unemployment rate without letting the inflation genie even further out of the bottle? Because I think the Fed knows better than anyone that that the psychology of inflation is very slippery, right? Once the genie is out, and people are expecting, and you get sort of, back in the 70s was the labor unions, it's very hard to put that genie back in the bottle. And so that's a test that the Fed has not had to deal with yet. And the excess demand for labor is being corrected. But at some point, a recession is going to happen, and depending on where inflation is, the Fed will have to make some tough calls, and it will get tested in a way that it hasn't been in quite some time. But clearly, the Fed made a policy error in 21. The transitionary, and you can see why it said that supply chain bottlenecks. Clearly, that should be transitory. But I think the Fed completely underestimated the effects of fiscal policy. And of course, it was a $5 trillion helicopter drop. So that's a pretty massive fiscal policy. And then it waited way too long to raise rates and to actually stop expanding its balance sheet. I mean, that didn't happen until the spring of 2022. And that was the effect of policies that the Fed itself created, right? I mean, after so many years of underperforming inflation, if that's the right way to even put it, the Fed had a new policy. Remember the average inflation target, AIT, and basically it said, we're not going to respond to inflation until we see the whites in the eyes of inflation. And of course, once you do that, it's too late, which the Fed learned in 2022. And then the other policy, not an overt policy, but the other unwritten policy that it had was, if you're gonna do a taper of QE, and revisiting the taper tantrum of 2013, if you're gonna do that, you need to announce this first, then you need to taper, then you need to stop doing any balance sheet expansion, and then you need to announce the shrinkage, and then you need to actually do it. And by the time you've gone through all these iterations, probably 6 months have gone by, and they can't raise rates until they actually are done with QE. Imagine doing QE and raising rates at the same time. And so when you add all of those two things up, it kind of prevented the Fed from responding in a much more nimble way than maybe it would have done, like if Greenspan was at the Fed. And that's why the policy response was so slow when inflation really became a clear and present danger at a time where fiscal dominance was already underway. And that's why the Fed had to go so hard so fast, because it had waited too long. And now it's preventing the Fed, I think, from easing as much as maybe it would have done in years past. But I think right now the Fed, I think, is in an okay place. If inflation is 3.5, and the neutral real rate is 1%. I mean, that's kind of a typical real rate when the economy is expanding. That's also our star, maybe plus 1%. You add those two things up, you get to 4.5 as a neutral rate, which is far above what the Fed's SEP says it is, right? The Fed thinks, per the dot plot, that neutral is 2.5, 3. I think that's way too low. So if it's 4.5, then at 5 3/8, the Fed is moderately restrictive, but not onerously so. And I think that is a good way to explain why the markets nor the economy are sort of hanging on for dear life, waiting for those rate cuts to happen. Remember, a year ago, the market was so obsessed with, when is the Fed going to cut? And that's because earnings were falling. Today, earnings estimates are growing 12, 13%. The market doesn't really need the rate cuts anymore, right? Again, think of it as the DCF math, right? Earnings in the numerator, interest rates in the denominator. if the numerator is not growing, changes in the denominator have a powerful impact on valuations. But if the numerator is growing double digits, even if the denominator isn't falling or even if it's rising, the market can handle it. And that's why I think the Fed has kind of a free option here to wait a little bit longer, because the economy and the markets are not really hanging on by a thread waiting for them. And the Fed is not really that restrictive. It's restrictive, it's above the neutral rate, but it is not as much above the neutral rate as it has been in past cycles. In past cycles, it would be 300 basis points above. Today, it's maybe 100 basis points, which is restrictive, but it's not that restrictive.
Mm-hmm. That's another really good rendition of what's happened here. I mean, I've always been of the belief that the Fed they say they have a dual mandate, but it's three-legged stool. We have where's inflation, where's the labor market, and where's the S&P 500. I mean, if we go to slide 45, actually the slide before the one I was showing. I mean, if what Jurrien just said is 100% correct. I mean, the economic data was, I mean, first of all, we were in an industrial manufacturing recession, European recession over that time period, and the data reflected it, and the S&P 500 had gone down double digits. The Russell had gone down almost 20% from July. So you had bond yields on the left side. Jurrien was pricing in at that point an egregious amount of rate cuts, but then the data turned. The global industrial recession bottomed. European recession therefore bottomed. You had a whole bunch of bottoms. Commodities market, which is the biggest leading indicator of all that bottoming, bottomed. Since then, like I always say, I mean, on the right side, we've swung the other way. I mean, the bond market has told you that everything that you just said is correct, in the sense that it's probably priced it properly. The bond market has in the currency market. I mean, if you're of the view, Jurrien, that you say, like you said, and I fill it out for Fidelity every month. The asset allocation questionnaire, like where would you be on everything, basically, and like if you think inflation's going to come down, you wouldn't be long commodities. You wouldn't be long gold, and oil's up 16% in the last 6 months. Gold's up almost 20. Copper's up 20. Gold's up something in between. But being just long of inflation has been a very good decision. Like, we bring this back full circle on everything you said. You're really, and this is not new to Powell or the Federal Reserve's history. The 1970s was a period that had that, oh geez, how do we deal with this teeter-totter of slowing labor and inflation staying sticky? Well, Arthur Burns went with the let's cut, and then inflation went up faster. And Powell's discussed this multiple times, that he doesn't want to do that. Would he do everything he's done, leave his job, and then be Arthur Burns, I mean, for a couple months? I don't think so, but the dynamics of the 1970s, from a total, like you said, even equity market cap, taking it all the way back to what you started with, why the concentration is a quad 3, or why commodities are working, to me, it's pretty obvious. It's the market's got it right.
Yeah, and it's funny you mentioned Arthur Burns, because we had a meeting with a former Fed official who will remain unnamed, but he said that everyone at the Federal Reserve, from the janitor to the chairman, knows the name Arthur Burns, and they, if there's one thing they have conviction in, is to not go back there. And I've studied that period very closely, as well as the 40s, because I'm intrigued by the financial repression of the 40s, the fiscal dominance, where it was really fiscal policy that dominated and the Fed kind of took a back seat. And of course, in the 60s, we had the Great Society, many parallels between now and the 60s. But that was a period of emphasis on employment. Nobody was worried about inflation because you had several decades of deflation. Fed policy was way too loose, while fiscal policy was very loose. Everyone was sort of asleep at the wheel, and then the great inflation was unleashed. And so I think the Fed knows all that, and as long as it remains, truly independent, I think it will be vigilant on that front. But you mentioned commodities. Obviously, the 70s were a very powerful era for that. But I'm very intrigued by the commodities markets, because when you look at really long-term relative trends, so a 10-year CAGR of the relative performance of commodities to stocks, or value to growth, or small cap to large cap, or non-US to US, and you look at it on a very long time frame, they're all the same trade, right? So they are all the same trade. And being long commodities actually is one way where you can play the mean reversion game without having to bet against the big mega cap
Yes,
growers that have so
exactly.
dominated. So it's possibly a way to have your cake and eat it too, because otherwise it's very binary, right? If you're going to go after value or small caps or non-US, by definition, you have to, short, at least on a relative basis, these big growers. And like, who wants to short these stocks when they're dominating so much and you don't have the catalyst that we described earlier? But if commodities tend to do the same thing,
Hmm.
you can actually be long commodities as a play on that without actually having to be short the FANGs or the Mag 7, et cetera. So, and it's an interesting chart. It's been a frustrating place, of course, the last few years. It's the one area that normally is economically sensitive that hasn't really, done that well. I mean, gold has broken out recently. I think that's a whole story on its own. But it's a fascinating chart, and over the very long term, investing in commodities doesn't make a lot of sense, like really long term, because by definition it generates the inflation rate. I mean, that is inflation,
Yep.
while having an annualized volatility of like 20 or 30. It has the volatility of emerging market stocks while only delivering the inflation rate as a very long term performance. But there are pockets of time where they really, really do well, and then it's worth taking on that additional volatility.
Yeah, that's thanks for saying that, because again, I think that 60/40 is as long as we have higher for longer, a 60/40 portfolio is going to get absolutely crushed by like our go anywhere strategy, where we'd be long India, mega caps, silver, copper, gold. I mean, that's my portfolio, right? I show it every day. And I think most people probably wouldn't even know that silver's up more than the Nasdaq in the last 3 months, but it is. So these are good things if you're positioned properly for them. I wanted to spend some time on this fiscal dominance that Jurrien keeps mentioning, because he's the only person on a live mic that's been willing to throw that out there. So if you just look at that on slide 122, guys, we show what that actually means in terms of the definition of it. And to make a long story short, what it is it essentially handcuffs the Fed, okay? So the Fed can't do what it normally would be able to do because the fiscal keeps doing the other thing, which, and look at that chart, Jurrien. Like, I mean, interest expense, people have said it doesn't matter. Well, it hasn't mattered, but it's going to matter. I mean, if it's higher for longer, that's what interest expense is going to do. So we're showing that against defense spending just to provide some context. What do you think? I mean, you've already thought about this. I mean, the next slide we actually show what Jurrien said, which is he's interested in the 1940s. I mean, the guy's like an encyclopedia. Look, all the fiscal dominance periods included the 1940s. Post-world, if you go World War II, 1939 to 45, you got the American Revolution, French Revolution, Civil War, et cetera, et cetera. So it's not like this thing isn't a thing. It's a big thing. So can you expand on that?
Yeah, it's a huge thing, and maybe it's the biggest thing that we're going to be talking about for the next 5 or 10 years. So yes, fiscal dominance means that fiscal policy is very powerful, as it is today, right? We're having 7% deficits at a time of pretty decent economic expansion. I mean, the unemployment rate's at 4.1, and we're running deficits of 7% of GDP, and they're very persistent deficits. And so those deficits need to be financed, of course. And in the past, over the last couple of decades, it would be the central banks that would do it. The Fed, of course, here, but also the ECB, Bank of Japan. I mean, Japan is the ultimate example of fiscal dominance, which is where you have a dominant fiscal policy, but you also have a central bank that is subordinate in that equation, right? Which the Bank of Japan has been actually literally pegging bond yields. And that's what the Fed did in the 40s, right? The Fed became independent in 1951. Which certainly hasn't prevented governments from trying to meddle in monetary policy, which they certainly tried to do in the 60s, whether it was Nixon or Kennedy. They all tried to influence Fed policy. I mean, Trump did the same thing in his last term. But the Fed was back then, before 1951, the Fed was really an arm of the Treasury, right? And the thinking back then was, okay, Congress decides how much money to spend. And if it spends more money than it receives, then you have a deficit. The Treasury's job is to finance that deficit. And the Fed's job is to not get in the way of that, and maybe at an extreme to even accommodate that, which the Fed did in the 1940s. So the Fed pegged bond yields at 2.5%. It pegged T-bill yields at 3/8%. And the 2.5% was for no other reason that that's where yields were prior to the U.S., joining World War II and running up the debt from 40% of GDP to 120. And there was kind of like a moral contract or a social contract between the government, including the Fed, and the investors who financed the war, which was mostly banks, to say that, we're going to defend par on those bonds because you're funding the war. We're going to make you whole. Of course, there's the inflation thing and the erosion of purchasing power, but people didn't really think of that back then because that was coming off the Great Depression and very large deflation. But that was the idea, and the Fed did exactly that. And the Fed increased its balance sheet tenfold. So that was actually the Fed was doing QE back then, but the Fed was very clever, and it really it got the banks to do most of the heavy lifting. So the Fed really created a massive carry trade for the banks, and the banks would just sell their T-bills to the Fed at 3/8 and buy Treasury notes at 2.5, and they were printing money. And so that was financial repression, fiscal dominance in its purest form. In the 70s, 60s and 70s, it was more indirect. And of course, now we don't have that technically at all yet because the Fed is actually being restrictive and not being subordinate. But we don't know if that will continue. And one of the reasons the dollar is so big is because we have the juxtaposition of a loose fiscal policy and a tight monetary policy. But if that ever changes and the Fed goes loose when the fiscal is loose, and the fiscal is going to be loose for many years to come, you point out the debt service, which is now $1 trillion and rising, that will just get added back to the deficit because there's not enough discretionary spending in the budget to really make austerity work, and austerity is not really politically feasible anyway, and you don't hear either of the two presidential candidates really being too worried about spending money that the government doesn't have. So it's not really a political issue. Both sides of the aisle are equally guilty of spending money. And so once you add entitlements, defense spending, and debt service, there really is not much left. And so we're going to have deficits for a long time. And then it's really a question of, can the Fed be independent in that situation? Can they really be restrictive? Because that would obviously drive debt service even higher. And will there be political pressure for the Fed to be more submissive to the fiscal side? And if that's the case, what happens to the term premium on bonds? There are so many iterations where all of this really matters and feeds into, again, like you said, the 60-40 asset allocation paradigm. 60-40 works when inflation is low, but bonds historically have been positively correlated when inflation is high. And of course, they have been positively correlated over the last couple of years. And every wobble in the stock market over the last couple of years has come from rising bond yields, which is how it used to be, right? Remember the days of the 80s, the Fed model, which Greenspan always talked about? That was the old era of rising rates being fine until they're not, and then they caused the stock market to wobble. And then we went into an era of the great moderation, where we had a negative correlation, where it was falling yields that freaked out the stock market because that was a fear of deflation, and it was rising yields that were like, okay, everything is all right, the system is reflating. If we're back to the old days of the 60s, 70s, 80s of positive correlations, then it doesn't mean you don't want to own bonds, but you don't own them for the same reason that you did 10 years ago, which was to provide insurance. Now you can own them because they have a positive real yield and they provide income and they have a generally a lower volatility than the stock market. But just this is just a way to try to explain that fiscal dominance as a topic or as a theme has the potential of feeding into all angles of what we do as asset allocators.
And I appreciate that. I mean, you saying that, one, because this isn't, corporate control media. It's not government bias media. This is we're just analyzing empirical data. And you said this could and probably will be the biggest topic. What's amazing about it, though, is that the Fed, and they have to be called out on this. I mean, they don't really talk about it. They write about it. Like, look at the next slide, slide 124. The St. Louis Fed, this is their quote. Inflation would rise potentially by a large amount. So it's not like they don't know what the conclusion could be on higher for longer deficit spending and debt. It's just not what, and there's a question in this, we're in the era of hyper short-term macro tourism, where we'll get the CPI on Thursday and every Tom, Dick, and Harry who's never had an inflation model Jurrien is going to have an opinion on it. The markets are going to move for 2 hours. But this thing's still going on in the background, the deficit and the debt, which to me is the most inflationary thing structurally that's changed. You can't and that's another question too, I guess. I mean, is whoever's elected, would you envision a Federal Reserve that actually says, hey, look, inflation's going up again, and it's not because of us, it's because of this it's because we're being dominated fiscally.
Yeah. I mean, I think the Fed generally tries to stay out of politics, but I've seen instances where Powell would get sort of grilled about the deficits, and he would say, deficits are bad, they cause interest rates to go up, or this or that. But I can certainly understand why they would rather not go there. And it's also nothing that they can control. It's not like all of a sudden, Congress is going to stop spending money just because the Fed wants them to. But the Fed is in a different position than it has been in the past, where in the past, it would be a conspirator, if you will, and now it is trying to either overtly or covertly trying to offset it. But again, it makes you wonder about Fed independence. I don't think the Congress is going to pass legislation that removes the Fed's independence, but it's governments meddle, and we've seen this in the past, and people can be appointed who are more friendly to certain outcomes, and the Fed's independence is pretty important. That's where its credibility comes from. And so it's definitely part of the mix of this fiscal dominance era, that if it persists long enough, are we going to go in the direction of Japan, where the central bank, either by mandate or just because of circumstance, has to lower rates because of crowding out and higher rates responding to deficits, et cetera. So it's definitely something you worry about. I mean, the U.S. has gotten a free pass many times in the past because it's still the global reserve currency, but its share of global reserves has come down. It's down to about 58%, which is still the biggest, larger than anyone else, but it used to be well into the 60s, and so it's come down. And the U.S. also benefits from the fact that everyone else on the planet has the same problem, right? Whether it's Canada or Europe or the UK or Japan or China. So you have too much debt everywhere, and you have declining demographics, right? Aging populations, and so you have the same story around the world. And so maybe the Fed is still the cleanest, dirty shirt on that front, especially if we have this AI boom, maybe giving us a path to higher sustained productivity. Because ultimately, when you have a large debt stock, there's only so many things you can do about it, right? You can default, which of course the U.S. wouldn't do. You can have austerity, which is politically, suicide if you're an elected official. You can inflate your way, which of course is the kind of the easiest way to do it because it's somewhat invisible, especially to bondholders who are financing the debt. Or you can grow your way out, which of course is what the U.S. did after World War II. And so my sense is that what we'll do here is some combination of growth and inflation. The inflation we've already talked about. And actually, you can see after COVID that the debt to GDP has actually come down after it spiked up, despite these deficits, because nominal GDP has been strong, in part because the economy has recovered, but in part also because inflation is running well above target. And so maybe a combination of growth and inflation is how we at least not get to these catastrophic levels of debt, because as long as your growth rate is above, as long as the growth rate in the economy is above the growth rate of the debt, it can be considered sustainable, or at least not unsustainable. And so the U.S. is the only one with the AI story, basically. So maybe that gets us out of jail yet again in the U.S. But a lot of things need to happen, in the right way for that to occur.
Yeah, it's a good thing it occurred. I mean, a lot of good things still occur for capitalists in this country, and that was a big one. Last question, and this is also a topic that you've already discussed briefly, but to me, it's also very relevant, taking this full circle within the context of both the conversation and the process that we have in common, like the rates of change of earnings growth. You mentioned that. Now, I had a call with one of your competitors yesterday where the CIO essentially said, look, what is the next big sector that's going to move that people don't own? Because, like, to your point, Jurrien, you called this out in a recent note of yours. We call it the bongo board, but the top 11 sectors in the S&P 500, which we can show. Like what is it, like something like 3 of them constitute like 70% of the cap?
Yeah, the top 3 are 70% of the cap, yeah.
Right, so I read that from you. So I did remember what I read. But something like energy. So energy is a very small percentage of the cap, but just looking at base effects and where oil is, base effects on earnings growth, people may or may not remember, but the second quarter of last year, energy earnings growth was negative 50%, right? So you have, now the oil price is up a lot relative to that kind of double bottoming of the industrial recession, oil price in the high 60s. And energy is as small as it's been for a long time, but if you're looking for earnings growth and you want to be positioned for inflation at any level, that was my answer to the question. So I wondered what you thought about that, because this is going to be a massive earnings acceleration for energy stocks.
Yeah, no, I like the energy sector a lot, and over the past few years, it's ironically been energy and tech kind of doing this dance of who is the lead sector. They're kind of odd bedfellows, It's like energy and tech. Okay, who would have thought? But there's a lot of reasons to like energy. I mean, obviously, it's on the wrong side of the ESG spectrum in the minds of many. But that also creates an opportunity, because if that starves the sector of capital, because pension funds or whatever endowments don't want to go there, that creates boom bust cycles, which obviously includes the busts, but it also includes the booms. And then if you have some global recovery, which I think we're seeing now, and you have capacity restraints, as we also do in oil, and you have a very small sector that could easily gain a lot of attention when the other side of the market is very, very large. There's all kinds of things that can go right. And again, it's another way of sort of playing the commodity theme, but without actually buying the commodities, because then you have to wonder, how do you buy them? Do you buy futures? Do you have to deal with roll yields and all that kind of stuff? So buying the commodity sensitive equities is kind of a clean way, especially if you're forced to be in a 60-40 construction where commodities become an out of benchmark bet with massive volatility, and it eats up your risk budget, and you get all those kinds of considerations. And it is, again, I think it's a good hedge against the dominance of these dominant stocks eventually fading. And again, that's not an indictment on the companies or their fundamentals or the AI story. But at some point, these companies, these stocks are going to be overloved and overcrowded. And even if they're not trading at a valuation extreme, at some point they're going to start missing, like, not the earnings estimates, but the whisper number, right? And you know how this game works. It's like it's no longer good enough to meet earnings or to beat earnings. Now you have to beat the whisper number, and you get into kind of the third and fourth derivative of if anything starts to erode that momentum, the hot money, the tourists, they flee. And then you want to have some position in the stuff they're going to flee to, or just the market math of the cap weighted then coming down to the equal weighted and what that does to the relative breadth. And so I think it's very important to be thinking about this, even if we are still missing that catalyst that you and I were talking about.
Yeah, I was just looking at that as you're saying it, because you can go back across, very few do it as well as you do in terms of taking all snapshots in history and seeing how many times this has actually happened. But I'm sure you've already done the work, but if you haven't, something like Exxon. How many times has Exxon been top 5 to 10 market caps in the US stock market? Multiple times, right? And sometimes it takes some time. But this Exxon right now, I'm going to say only has a $500 billion market cap, but obviously Nvidia's is north of $3 trillion. So, that's, to me, we also, and I appreciated the discussion on valuation. While I don't think it's a valuation itself is a catalyst, growth at a price, if you get some cyclical growth and maintenance of the oil price up here, now I have a catalyst, right? So it's something that's actually cheap with a catalyst, which would be energy stocks. I don't know what the stat is on Exxon, but there have been multiple times where it's been in the top 3.
And I'll just add, and we haven't really discussed this, but share buybacks are an important driver of valuations, even though we could argue that they shouldn't be, that the capital should be used for other things. But if you think about the discounted cash flow model, right, it's not so much earnings growth that we have to solve for. I mean, it is, but it's also how much of that earnings growth is returned to shareholders, right? And so dividends, of course, is the traditional way of doing that, but share buybacks have become a powerful indirect way of doing that over the last 20 years, right? So the buyback era, by my account, started in about 2004 or so and have been a dominant feature of the US market, much more so than international markets, right? You don't really see this in Europe or Japan or emerging markets. And so it's like a bird in the hand, right? So if a company is making earnings or free cash flow and it satisfies its R&D needs, and then sits on this cash and says, okay, what should we do with this cash? Do we hold it on our balance sheet, or do we return it back to the shareholders? People at Fidelity will say, well, if you're just going to sit on the cash, then give it back to us, because that's the bird in the hand, and that commands a higher PE. And the reason I mention this because again, I don't do individual stocks, but Exxon is probably a good example of a company that has enough capital discipline that if oil prices go up above their cost in such a way that they generate a lot of extra cash flow, they're probably disciplined enough to return that cash to investors rather than chasing those higher oil prices by drilling more holes in the ground, which has historically been, catastrophic for these companies, which is why they have the boom bust cycles, right? Because then oil goes back down. So anyway, I mentioned that as an example of a very large company that can do that, and if it's trading at a fraction of the multiple that these FANGs or the Mag 7 are, there's a real opportunity there.
Yeah, it is definitely not an expensive stock, and they also pay a 3.5% dividend. So we went. I mean, I could talk to you all day, obviously, but we did quite the conversation here. We went around a lot of different topics and through them that I'm sure many people are quite interested in. So thank you for your time and for providing the Jurrien only education, which you tend to do in global macro.
Great. Well, thank you very much, Keith.
We'll see you again on the next Real Conversation. Thank you for joining us.